Okay, the reason why market's fixated about rate increases is there's a couple of historical precedents that generally when the Fed starts hiking rates, equity markets derate. So what I mean by that is their PE falls. Now, over time, that hasn't been a bad thing because the Fed's normally increasing rates because the economy's doing well. When the economy's doing well, it means also earnings are going up. So the combination of increased earnings but a derating, net still results in a positive stock market. This is a really interesting cycle because post 2007-8, we're actually now the better part of 7 years into this cycle. And earnings growth's actually decelerated, give or take a couple of percent, maybe flat year on year, depending on what forecast you want to use. Now what that means is if you derate, like you would normally into a Fed hike cycle, net you're going to have a negative negative actual growth year on year in the actual stock market. So that is a negative for people. The third thing is, depending on how far you get into a rate hike cycle, but generally rate hike cycles have ended with blowing something up somewhere. The GavCal guys refer to as fishing with dynamite. That drop a few sticks of dynamite in the water, some fish float up, and every so often you might end up with a whale floating up to the surface. It's the monetary policy works, as Friedman said, with long and variable lags. And what's happened in the early 80s, ultimately Fed hikes coming out of 78, 79 resulted in Brazil blowing itself up. Coming out of 91, you had originally the savings and loan crisis of the US, but you also then had in 94 in the bond market sell off the Mexican peso crisis. The 2000 rate hike cycle resulted in the dot-com bust. And then the most recent one, the 07 one, was the US housing bust. So you do have a lot of history here that says a number of rate hikes result in bad things outside the US.
So assuming there is a rate hike, where would you not want to be invested?
So historically, there's a few examples of things that you generally don't want to be long defensive stocks if there are a number of rate hikes. So utilities tend to do poorly in this environment. Any long-dated cash flow assets tend to do poorly. So high duration assets tend to do poorly into this. Historically, things that did well was because they were hiking rates because the economy was doing so well. What you call rate cyclicals or rate sensitive stocks would be materials, oil, which some of this may sound counterintuitive because at the moment it doesn't seem that way. But those things often do well into these hike cycles. But as I said before, this is a really weird cycle we're in. You're coming into this with quite weak offshore growth. You've got oil looking negative. They've got a strong US dollar, which is hurting the US industrials, which tend to do well. So it's quite an odd setup here. What's continued to do well amongst all of this is US consumer discretionary. The market, rightly or wrongly, has bet that the US consumer, more people with jobs equals more spending power equals better for these stocks. It's debatable how well these go next year. They do have sensitivity to interest rates. Other things that do well are home builders, tend to do well in this sort of environment, is that as long as rates don't go up too much, the fact you're getting a job tends to outweigh the negative you're paying a little bit more on your interest rates.